The three major U.S. banking regulators want to rewrite many outdated regulations tied to the Community Reinvestment Act, a decades-old banking law. Federal Reserve Board, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency believes the law designed to encourage lending to the poor and racial minorities in the areas where banks have branches needs revamping. FDIC Chairman Martin J. Gruenberg said the substantial impact would come from modifying the act.
The Board of Directors of the FDIC, jointly with the Board of Governors of the Federal Reserve System and the Comptroller of the Currency, is today acting on a Notice of Proposed Rulemaking, or NPR, to make comprehensive amendments to the Community Reinvestment Act regulations. This has been an ambitious undertaking. The proposed changes to CRA are substantial. They would significantly expand the scope and rigor of CRA and expand access to credit, investment, and basic banking services in low and moderate income communities across the United States. These communities have been the most severely impacted by the COVID-19 pandemic. For that reason, among others, action on this NPR takes on a particular urgency.
Joining me now from Washington, D.C. is Jesse Van Tol, the president and CEO of the National Community Reinvestment Coalition. How are you doing today, Jesse?
I'm doing very well. Thanks for having me, Michael. Honored to be here.
All right. Thanks for joining us. So this is something very interesting. I remember back October 22nd, 2021, Attorney General Merrick Garland did a press conference to talk about this initiative. And what's interesting is that redlining, we know it's a practice that dates back to the 1930s, right? And coming from the federal government and the Homeowners Loan Corporation. Can you explain, redlining is illegal, so how is it still happening today?
Yeah, that's right. I mean, we've passed a number of laws to deal with racial discrimination in lending, including the Community Reinvestment Act of 1977. But you see all different modern forms of redlining, something called reverse redlining, where people of color are not excluded from financial services, but they're actually targeted for financial services that are more predatory, more costly, less good, frankly, than the best alternative. So, CRA has been a critical part of addressing that. On Thursday, the regulators proposed a much-needed update to CRA to reflect the fact that, changes in the financial services landscape. A lot of banking is no longer done in the bank branch, and what
Right.
they're trying to do is breathe life into this regulation in some new ways.
Okay, so this is another example of how the law has to catch up to the technology, right? I was reading an article back from October 22nd, 2021 from CBS News, Justice Department to investigate, quote unquote, digital redlining in lending. Okay, so this sounds like an example of how the law has to catch up to the technology. Is that what we're looking at?
That's right. I mean, the law is an examination of banks for their lending practices, but it examines them where they have branches. And we know that a great many banks today are doing a lot of their business online with customers. There are entire banks that have no branches. They're online banks. And those banks were getting examined under CRA just in their headquarter city. Many of them are headquartered in places like Salt Lake City for tax reasons. And so there wasn't really a robust examination of their lending practices, their investment practices, and how they were providing banking services to people. And this update would change that, would fix that. There's some things it doesn't do that would require legislative changes to the law, and that's covering companies like mortgage companies or non-banks that don't take deposits. Those are still not covered by CRA. They are covered by other fair lending laws, but those companies don't have the same kind of obligation to affirmatively serve communities that historically have been redlined.
Okay, so here are the key elements of the law the banks want to see changed. Okay, we have expand access to credit investment and basic banking services in low and moderate income communities, adapt to changes in the banking industry, including internet and mobile banking, provide greater clarity, consistency, and transparency, tailor Community Reinvestment Act's evaluations and data collection to bank size and type, and maintain a unified approach. So, Jesse, can you explain to our audience? Oftentimes we focus on the racial wealth gap. Can you talk about how the Department of Justice, led by Attorney General Merrick Garland, attacking this digital redlining will help close the racial wealth gap?
Yeah, it's so we see a number of institutions not covered by CRA, not covered by fair lending laws in the way that they're serving people of color, Black people, Latinos. It's sort of a wild west out there when you think about what's happening on your mobile phone, the changing nature of financial services, how people are banking today, on their phones, with new and different companies. And we certainly see,
right,
I mentioned before, reverse redlining. That's really the targeting of people for higher cost financial services. They may not even know that they're paying more. You see lots of small business owners, for example, going online to get small business loans. You see alternative forms of financing cropping up, people going to, no longer to their banks, but to new and different companies. We saw during PPP lots of scams targeting people to try to help them with a PPP loan. And those are examples of, companies that operate outside of the regulatory infrastructure that's in place that are not covered by many of these laws like CRA, but they are covered by fair lending laws, and the Department of Justice can go after them for digital redlining, for digital discrimination, for use of things like algorithms in their, artificial intelligence that may be baking in factors that are discriminatory on the basis of race, without necessarily explicitly saying that they are discriminatory. We've seen lenders use in underwriting models things that are proxies for race, that disproportionately impact people of color. And it's not on the face of it problematic, but when you dig into it, things like what social media platforms people are on, or what hours of the day they post to social media, or did they graduate from college? Do they write in uppercase or lowercase on their social media pages? These may sound silly and as though they have no impact, but turns out there are racial differences in how people do those things, and companies relying on that kind of data in their loan process to do underwriting to determine whether or not you're a good bet for a loan or for banking services could be discriminating. And those are the kinds of things I think the Department of Justice, the CFPB, and other regulators are looking at to go after.
Okay, so you just said a lot there, Jesse. I think a lot of people don't know how deep this is and how pervasive this is. Okay, I'm going to go to my panel here in just a minute, but you talked about algorithms. Okay, so can you? I mean, we talk about driving while black and walking while black, things like this. But okay, explain the algorithms and how the algorithms can discriminate against African Americans who are applying for bank loans, et cetera.
Well, sure, a couple of different things. So, increasingly, fintech companies and including a lot of banks are using, sort of big data, machine learning, artificial intelligence to figure out whether they think someone's creditworthy and a good bet for a loan. And essentially what you have is, AI, artificial intelligence, looking at a whole bunch of different data, including data never before used in lending, to come up with, an algorithm to figure out whether someone is a good bet for a loan or not. What's their likelihood? What's the risk of them defaulting on that loan? And one of the problems is depending on what goes into that algorithm, it can be discriminatory. And in fact,
Right.
some companies are using machine learning to where, the computer itself, the AI itself, is coming up with new ideas as to how to underwrite differently. You put in bad data, you get bad data out, right? And so we've seen some of those practices be problematic in terms of how it impacts access to capital and credit for people of color, for low-income communities, and other underserved communities and people.
Okay. Now, the 1977 law, the Community Reinvestment Act law, addresses fair housing practices. The proposal will undergo several revisions and should be finalized later this year, later 2022. Now, is this something that has to pass Congress, or can it just totally be handled by the Department of Justice?
The proposal issued on Thursday by the three bank regulatory agencies, the FDIC, OCC, and the Federal Reserve, can be finalized by those agencies. What can't be done is expanding the law to cover other types of companies. That would require an act of Congress. So you can't apply the law to mortgage companies, to certain fintech companies, insurance companies, and the like. But those banking agencies can act and will act to finalize these proposed changes later this year, as you said, and that'll be subject to a public comment period where anybody can comment and suggest ways in which the regulation could be strengthened. And we certainly plan to do just that.
Okay, because I was wondering how this would also impact the lawsuit that Ben Crump just filed against Wells Fargo when it came to apparently the huge article from Bloomberg News from March 2022 about Wells Fargo only approving 47% of African Americans who were applying to refinance their home mortgages, which was much lower. They were the only, according to the analysis from Bloomberg News, they were the only mortgage lender to turn away more African Americans than they approved. So I was kind of wondering how this initiative here from the Department of Justice will affect that, if at all, or a bill has to pass Congress to address Wells Fargo if it is found by an independent study that Wells Fargo in fact only approved 47% and turned away more African Americans than they approved for refinancing their home mortgages.
Yeah, no, it's very relevant. It's the original sin of the Community Reinvestment Act. It was passed in response to redlining, which was race discrimination, but it was passed on the basis of income.
Yes.
The regulation to date has spoken to low and moderate income people and low and moderate income communities. And obviously there's, significant overlap there. But one of the things the regulators are proposing to do is to incorporate data on lending to people of color, including the kinds of statistics you just cited with regards to Wells Fargo, on the CRA exam to really look at that and include that as part of the analysis, city by city, place by place. How well are banks doing at lending to African Americans, to Latinos? They're also doing things like separating some of the data that was in CRA before. The law speaks to low and moderate income people. Well, they're separating low from moderate and really looking at each distinctly. The law speaks to lending to small businesses. Well, they're separating the very smallest small businesses from other small businesses. And we know that disproportionately the smallest businesses are owned by people of color, are owned by women. A lot of Black-owned businesses have no employees. Right. They're quite small, and they're in need of microloans from the banks. And the banks tend to focus their efforts, at the higher end of what's allowable under CRA. And those kinds of changes proposed on Thursday could really help expand access to capital and credit for the smallest businesses, for low-income people. And again, by incorporating race data, it'll shine a light within CRA on the kinds of practices you mentioned earlier.
Absolutely. Well, that's definitely good news. I want to bring in my panel here and see if they have any quick questions for you, if you don't mind, Jesse. First, we have, these are regulars here, Roland Martin Unfiltered. Kelly Bethia, JD, communication strategist. How you doing, Kelly? Matt Manning, civil rights attorney. And Dr. Jason Nichols, senior lecturer, African American Studies Department, University of Maryland, College Park. So let's start with Kelly. Kelly, do you have any questions for Jesse regarding the Department of Justice cracking down on digital redlining?
Sure. My main question is, with everything that's going on as far as interest rates and inflation, how impactful will this regulation, revised regulation be to minorities, considering that there's an interest spike when it comes to, a spike in interest rates, rather, when it comes to lending from these banks? And secondly, will there be penalties for banks who do not comply? Is this a mandate, or is this just more like you can do this, like a suggestion?
Yeah, both great questions. So certainly interest rates, that makes housing less affordable. It costs more to buy a home, and that's a big part of the equation. We've seen interest rates rise and fall. I think they'll remain high for some time. Eventually they'll come down again. But one of the things that this law does, what CRA does, really encourages banks to establish programs to help people get loans, including things like special purpose credit programs, targeted lending programs to people of color that come with them, maybe lower interest rates, and in a lot of cases things like down payment assistance. We know that having the money for a down payment is just as important, if not more important, than the interest rate in terms of being able to buy that home and that home being affordable to you. So yes, interest rates play a big role in whether houses are affordable or not. Historically, we've seen interest rates even higher than we've enjoyed for the past 20, 30 years. In the 70s, interest rates were in 7-8%, and people still bought homes. But there's no doubt that lower interest rates makes it more possible for people to buy a house. So certainly there's an interplay of these things. But CRA gives kind of a big nudge to banks to help figure that out, figure out lower interest rates or special programs. With regards to enforcement, this law, it has some teeth and is getting more teeth with the proposal on Thursday. So a bank that fails its CRA exam, and more banks are expected to fail their CRA exam under this proposed regime. A bank that fails is not allowed to open branches, not allowed to merge with other banks, is really in sort of the regulatory doghouse, so to speak. There are other consequences and impacts as well.
Okay. Matt Manning, do you have a question for Jesse?
I did. Jesse, thanks for being with us this evening and for explaining this issue to us. I read in one of the articles that there's a concern by the larger lenders that this is going to increase significantly their regulatory and compliance costs. In your view, is that actually something that is a concern for those lenders, or is that more kind of a subterfuge and a way to push back against further regulation against those banks, particularly as it relates to, an interesting or thorny topic like lending to people of color, women, and other historically disadvantaged groups?
Yeah, I'm not sure that banks have ever met a regulation that they liked and didn't think would increase their costs. I think obviously every regulation has a cost. The question is, what's the benefit? And I think here there's clearly a benefit to society of banks doing a better job of something that they should be doing on their own but are not. And that's being fair to people and investing in all communities and making loans to all people. And it's sad that 40 years after the original passage of this law, more than 40 years since passage of the Fair Housing Act, that we still have to mandate and legislate that banks treat people fairly, that they invest in minority communities. They build affordable housing. So certainly there's a cost to doing this. I think it's far outweighed by the benefit to society of requiring these banks to do this.
All right, and Jason, did you have a question for Jesse, Jason?
Yes, I do. Thank you for being with us. I had a question. I was really blown away with your statement about algorithms and data collection. And so I was wondering, is this something that is systemic that we see with all banks, or is it something that you're seeing with just some individual banks where there's an individual banker who's looking at someone's loan application and decides to go to their social media? How widespread is this problem, and how does the regulation that the FDIC and the other regulators, how does that actually deal with the issue of data collection and algorithms and things that are leading to discrimination in that way?
Yeah, so to be clear, there's laws and regulations that really govern what you're supposed to do when you make a loan to someone, right? There's things that banks are supposed to rely on. It's allowable to rely on your credit score, even though there are some problems with that, on things like your income. But what I was speaking to very specifically, fintech companies are really transforming the lending landscape. Folks like Square, PayPal, and others who are really transforming the way loans are made. And some of these companies, are fair and responsible, and others are using, novel approaches to underwrite a loan, looking at, sort of beyond your credit score, beyond your income, other factors. And, those are not automatically bad or good. Potentially looking at other things could expand some people's ability to get a loan. Something not included in a credit score is your history of making rental payments on time. And for most of us, starting out as renters, that's what you do. That's how you, how you're paying for housing every month. To not count that is a disadvantage. So there's possibilities to expand access by looking at other data, but some of it can be very problematic. And the regulators are absolutely looking at this and looking to crack down on some of the more problematic behaviors.
All right, thanks, Jason. Okay, Jesse, well, look, we really appreciate this. And once again, everybody, Jesse Van Tol is the president and CEO of the National Community Reinvestment Coalition. How can people find out more about the National Community Reinvestment Coalition? Is there a website, social media platform, et cetera, they could get more information?
Very easy, ncrc.org is our website, and they're also welcome to attend our national annual conference, June 13th and 14th in Washington, D.C., the Just Economy Conference.
Okay, nrc.org, nrc.org?
ncrc.org.
ncrc.org. All right, Jesse, have a great day. Thanks for coming on Roland.
Thanks so much.
Okay, the Biden-Harris administration is keeping its promise to relieve Americans from their student loan debt. So far, the Department of Education forgave 110,000 borrowers totaling around $6.8 billion under the Public Service Loan Forgiveness Program. The program became law in 2007 and is designed to forgive debts for people working for nonprofit organizations or government who made payments for 10 consecutive years. The program was full of technicalities, making it difficult for borrowers to see the relief. But the U.S. Department of Education made temporary changes to ensure better management of the plans. The deadline to apply for the updated program is October 31st, 2022.
All right, folks, back to our Roland Mark Unfiltered video in just one moment. Folks, Black Star Network is here.
Oh, no punches! I'm real revolutionary right now.
Support this man, Black Media. He makes sure that our stories are told.
Thank you for being the voice of Black America, Roland.
Stay black. I love y'all.
All momentum we have now, we have to keep this going.
The video looks phenomenal.
See, there's a difference between Black Star Network and Black-owned media and something like CNN.
You can't be Black-owned media and be scared.
It's time to be smart.
Bring your eyeballs home.
You dig?